at with the level of debt that we have, the amount of kind of fiscal largesse that's happening, there's really only one way this can go. And I think, people are finding out that gold is really the only safe haven trade there is. And it's just now that, the major financial institutions are starting to talk about it. So yeah, I think it's still early days. Gold is really one of the only safe places to be.
Edward Bonner, investment advisor over at Sprott Global Resource Investments. It's a true pleasure to host you on Palisades Gold Radio today.
Thanks for having me. It's a pleasure.
Excellent, Edward. I would love to talk about gold for a second. Of course, today, as we're recording on the 21st of October, Tuesday, gold is having quite a pullback, and gold miners as well. What do you think is currently happening to gold?
I think this is just a natural pullback. It's a release of, the tension that we've had over the last 2 weeks. We saw it on Friday. There was, strong kind of buying towards the end of the day, but it's a build up of weaker hands that need to be progressively shaken out. And I think it's a natural progression of a bull market. I wrote about it, and I've got the letter pulled up here, but that there would be these kinds of pullbacks when you're in overbought territory. It's certainly an under-owned trade, and you talk to anybody kind of on the street, nobody really owns gold. Central banks, financial institutions, they own gold. They've just started talking about, adding it to the 60-40 portfolio or changing that around, but it's still drastically underowned. And so I think this is just, a natural pullback due to overbought conditions and, maybe jitters over rate cut expectations, changes in geopolitical dynamics with, potentially a ceasefire in the Middle East, which, I mean, we'll see how that goes. But yeah, that's my take.
Well understood. No one can, of course, argue that the gold on the RSI is currently overbought. However, in your letter, you actually wrote about a bit longer-term perspective on sentiment, and it seems that the gauge that the start of the bull market might have just begun.
Yeah, I mean, it's really completely underowned. I mean, it's still below 1% in most people's portfolio. So, compare that to historical averages of, 6% or 7%. Go back to the 70s, and I think it was as high as double digits. And so, yeah, it's just completely, it's talked about, but it's not actually owned. And most people I talk to don't own it. They talk about owning it, thinking about owning it, but they haven't really pulled the trigger yet. And given where we're at with the current, debasement trade, or just, I mean, where we're at with the level of debt that we have, the amount of kind of fiscal largesse that's happening, and financial repression, I just think that there's really only one way this can go. And I think, people are finding out that gold is really the only safe haven trade there is. And it's just now that, the major financial institutions are starting to talk about it. So I think, and what we've seen in, our own physical trust products is a huge inflow into those. But that's only been over the last, few months. And that's mostly from, bigger institutions, not from, retail mom and pop buyers who, are really going to drive this trade to the kind of parabolic levels that we've seen in past bull markets. So yeah, I think it's still early days. It's not it's not kind of the cheapest you could get it for, and it's definitely not the easiest part of the cycle. But and there's certainly going to be some rocky roads ahead. But given just with the amount of fighting and lying and stealing that's happening kind of at the federal level and between countries, I just think gold is really one of the only safe places to be.
Incredibly insightful to hear that, of course, your products at Sprott are now seeing some good inflows into your bullion products. However, you also wrote about the GDX, which is, of course, an ETF tracking large cap miners, and that has seen mostly outflows this year thus far, hasn't it?
Yeah, I've got that chart pulled up here, but yeah, it's crazy. I mean, the GDX has gone up in value, but only because the constituents of the GDX have increased in value, but the net shares have actually declined. I think they're down like 25% over the last year, which is just nuts. I mean, it's not what you'd see in a bull market at all. So that gives me, the kind of conviction to stay long, because yeah, the GDX is reflecting um, basically people are still bearish, mining stocks. In any way, yeah, most people who are starting to look at the trade aren't looking at mining stocks; they're looking at physical gold, which is starting, that is seeing net inflows. The GDX, though, is not, and most gold mining ETFs are not either.
And when one looks at historical parallels, for example, the 1970s or the 2000s for these precious metals gold bull markets, how does sentiment tend to go in those historical parallels? Is it normal for there to be such a long bearish period? And how long could an inflow period into these funds last?
Could last a decade, could last 5 years, could last a few years. It really just depends on the rate of change. So, if we start to see really, really rapid rate of change, then, I mean, it's all based on indicators and relative value. That's really what you're looking for. You're not looking for an absolute price. So it depends on how fast other things are changing relative to your investment or that asset class. That's what's going to dictate the kind of the time period. But yeah, historically, probably a decade. That's the around the average. And the move historically in gold mining stocks has been anywhere between 500% to 1,000% in that time period. So today maybe 200 to 300%. If you're lucky, most people probably haven't seen those types of gains, but I'd say we're probably in the early, kind of in the, yeah, in the first half, maybe approaching the middle.
Today's episode of Palisades Gold Radio is proudly brought to you by our parent company, Palisades Goldcorp, Canada's leading junior resource investment vehicle, trading on the Toronto Venture Exchange under ticker symbol PALI, with equity and warrant positions in over 200 companies, ownership of mineral projects and royalties, and a 15% stake in newfound gold. Palisades offers investors powerful, leveraged exposure to precious metals, uranium, copper, and other critical minerals. Palisades shareholders directly benefit from our team's extensive industry knowledge and access to deal flow, opportunities historically reserved for a small group of investors. To learn more, visit us at palisades.ca and join us in our mission to level the playing field for investors. Now, back to the show. Talking about some of those indicators, what are those indicators that you're tracking? Is it, for example, the M2 money supply, or what are you tracking?
Yeah, I mean, M2 money supply, is usually well correlated to the gold price, or at least, the increase in the gold price. So yeah, that's a useful tracker. And so far, I mean, M2 money supply, I think I've shared a chart. Yeah, yeah, it's at all-time highs. So naturally, gold should be, in the same realm. And that's a useful tracker just to show that, yes, the government is still printing money. It's still employing, a policy of fiscal largesse, monetary debasement. And that should ultimately benefit gold, which is really just a hedge on inflation. It's also a geopolitical hedge, but at its kind of core, it's an inflation hedge. So yeah, I look at that. I look at the ratio of the Dow Jones Industrial Average to gold. historically, when gold has been overvalued relative to stocks is when that ratio hits around, 5. And right now we're probably around 11 or 12. And the S&P is still at all-time highs. So until you see that kind of ratio start to drop drastically, where, I mean, gold might still look like a good trade, but you have to look at it in comparison to other trades. And if you can buy, with 1 ounce of gold, you can buy 5 units of, the Dow Jones, then great. I mean, I'd do that all day. So it's just looking at things in terms of relative comparison and not just in absolute terms. But those are two simple indicators, and there's many more out there. Most of them I just forget. There's just so many. Yeah.
And how much of this gold bull market is due to a de-dollarization trade, for example, central bank buying or countries selling their bonds and buying gold instead?
Yeah, I mean that's you've definitely seen that recently. And I think I also shared a chart on that that's coming right up. Yeah, so I mean a lot of it's been driven by central banks so far. And central banks have been, were historically under owning gold up until really recently, really up until the U.S. decided to freeze Russian assets. And now it's, back up, over they now own more gold than they own in treasuries. So that's kind of a pretty, that means a lot. So it's not, they're not at all-time highs where they were in the 70s, and kind of 40, 50%. But I mean, they've been strong buyers up until now. And I think that if the U.S. continues to employ strategies to undermine its own currency and really kind of, potentially cause a soft default on its treasuries, central banks are not, they're not dumb. And if I were a central bank, I wouldn't want to own U.S. treasuries if the game plan is to just reduce the overall value of the underlying currency on those treasuries, and also reduce the absolute value of those treasuries if you were to go and sell them, which is kind of what we're seeing. Even when they're dropping rates, yields are still rising. So yeah, that's not a good asset to hold, in my opinion.
Talking gold miners for a second, the day that we're recording, 21st of October, Tuesday, is a fortunate day because a lot of gold miners are having quite a pullback. 5 to 10% is across the board. Is there still value to be found in the gold miners? And if so, where are you finding that specifically?
Yeah, I mean, look at Agnico, at spot price. It's still trading at like 1 times NAV. But there's still value even in the large caps. Where I find the most value are in stocks that can deliver alpha, can either be discovering more ounces, producing more ounces, or de-risking a project, either through, permitting or, building the project to production. So that's kind of where I'm looking at. That's the sweet spot. That's the area that, is still even more undervalued than the large caps. Obviously, the large caps have moved the most. So I'm looking at, growth producers, developers, and late stage explorers. Those are really the three that I focus on. The three that, have moved a lot, but still, trading well below NAV. And that's normal. I mean, there's still, risks in those projects, but in some cases, some of these development projects that are, I mean, they're just ripe for M&A, and given, how much the senior producers and even the mid tiers are producing in free cash flow, that means they have a lot of money to go out and spend, and they haven't really spent much on exploration. So, the logical thing is to acquire projects that are still trading at, sometimes 0.4 times NAV, even if they're, a tier 1, tier 2 project. So I think that's where I find the most value.
Really interesting to hear. What are some of the qualities that you're looking for to make a distinction between the higher quality projects who actually, become a mine eventually and generate that alpha like you outlined, versus the ones that won't?
The qualities, I mean, I think it's the mining team, in large part. Have they done it before? Do they know the area? Um, that's a big deal. If they've got past successes, that's already, a big kind of de-risking factor. So I look for the right management team to carry it through. Skin in the game is useful too. That means they'll be aligned with shareholders, and their interests will be aligned with you. Um, and then, we'll look at jurisdiction. Obviously, there's some places that have great mines, or have great deposits, but are just completely, uninvestable, either through, the risk of government seizure, like in Mali. Although maybe that's, kind of reaching kind of a plateau in terms of risk. Um, or maybe it's just, I mean, we look at the metallurgy, the actual, looking more closely at the deposit itself. It could be high grade, but if the metallurgy is bad, it's going to cost more to develop and to build, the right facilities to process it, and maybe your recoveries are going to be lower. So, we look at a few different factors, but it starts most of the time with the management team, and then with the asset, and then, I think the jurisdiction is kind of if it's not a right jurisdiction, you just don't bother. But yeah, those are a few things that I look at. And when you're looking at, exploration projects, a good one versus a bad one. A good one, a bad one, might be able to deliver really nice drill results. Um, but you have to put it into context. Has this been already drilled off? I mean, is this just an existing deposit? In these types of bull markets, or in every bull market, you're going to see a lot of projects come out of the cupboard. Things that just, never made it through the last cycle, were never good enough. And now, suddenly they're looking okay, and people are, bringing them out, polishing them up, and trying to fend them off. So you have to watch out for those. And there's always, some issue behind those projects, whether it be metallurgy, the continuity of the deposit, the area that it's in, permitting challenges. So, yeah, I mean, we try to look at the history of that project as well to see if it's been around for a long time, if it hasn't worked. But what will make a good deposit versus a bad one is really the continuity of the deposit, the payback period, the metallurgy, the management team. It kind of takes a village, it takes the confluence of factors to make it a good project.
Thank you, Edward. And talking platinum for a second, you've made an interesting call in your newsletter in May, end of May,
Yeah.
when platinum was trading around $1,000 an ounce. You were, of course, bullish, and now that call seems to be correct. What made you bullish back then, and are those factors still at play currently with where platinum is at currently?
Yeah, it was just a supply demand imbalance. And it was pretty clear to see. So that's that's all, and that's really, all there is to say about it. It was an unloved commodity, but with a kind of supply constraint and ongoing demand. So I just thought that it was too cheap to pass up on, and the target's probably around the 18 to $2,000 level. That might change, depending on a few factors, but that was really all it was just the supply demand imbalance. A lot of the discovery plays now are mostly palladium dominant. Not much platinum out there. on the discovery side. And actually, if you look at the Witwatersrand, where a lot of the development and exploration projects are located on the eastern side of the Wits, and that's actually more palladium rich than the western side. So much less platinum coming down the pike. And even, a lot of these, yeah, development plays outside of South Africa are also, more dominantly palladium rich than platinum. So, yeah, I see, basically an ongoing challenge for meeting demand on the supply side.
Incredibly interesting point there with these PGM, platinum group metals producers. They, of course, cannot control what their mix is. So platinum prices might be now attractive, incentivizing more production, but they're producing 5 other metals, and that supply just can't come on as quickly or specifically towards platinum.
Yeah, no, that's a good point too. And you see that in a lot of other commodities too that are byproducts. They're not. That's why you see tightness even in silver too. Silver is usually a byproduct. Either of copper mines, gold mines. Um, so that market is also a little bit tight due just to the fact that um, it's their the producers are not really that's not their main focus. So they're not. Um, there's always going to be this tension between supply and demand there. And, we've seen a big deficit, 200 million ounces in silver for a while now. But yeah, I think that's what creates the inelasticity of those types of kind of secondary metals. Yeah, it's interesting.
Well understood on that thesis on platinum. It was a supply-demand imbalance, and the commodity was hated. What are some other commodities that you're seeing right now that might be showing an interesting value proposition, just like platinum was in the end of May?
Hmm. Um, I mean, in terms of the unloved category, I think oil and gas and vanadium are two that are quite interesting. Um, both are subject to recession risks, obviously, um, but both are really, really unloved right now, especially vanadium. So I think those are interesting, but it's sometimes the market can remain irrational a lot longer than you can remain solvent, right? So it's difficult to time these. But I like looking at undervalued um, sectors of the market, especially when you've made so much money and you're probably pretty toppy in terms of your, precious metal exposure. It's always good to take some gains off the table, rebalance the portfolio. I'm in favor of having, focusing on where you have the most conviction, obviously. I think that's, how you make, the big money, but also, protecting your downside and not just having one leg to stand on, but having, a kind of a three-legged stool approach, or at least, having a more diversified portfolio. Um, and, these commodities are inherently cyclical. So there will come a time when, vanadium and oil and gas are back in favor. So yeah, I think those are interesting, but again, it's hard to time them. Um, I think rare earths and copper are quite interesting here, but they're by no means unloved at this point. But I think there's still some upside there too, especially with Grasberg going offline and this whole trade war between the U.S. and China causing disruptions in rare earth supply and causing really the U.S. to push for its almost a differentiated pricing in rare earths. So that's interesting. But again, it's just, these kind of political trends, copper less so, but rare earths, that's harder to predict just because you don't know when the trade war might end or what, they might do. That's something, and they could easily, come to an agreement where, suddenly rare earth prices come back down pretty pretty fast. So yeah, you have to watch out for those.
Could you give us a very quick crash course on vanadium? Really, what is it used for, and are there any major producers that one can look at to potentially play that hated commodity?
It's used for steel hardening, mostly, and vanadium redox flow batteries, which is kind of a nascent demand for vanadium. It's really hasn't impacted that market yet, but I think that'll be a kind of, a big driver in the years to come, because it's one of the best, energy storage mechanisms there are. So yeah, that's the primary use, and I forget your second question actually. Sorry.
No worries at all. Producers, are there any major producers that one can look at
Oh yeah,
to play
yeah,
this hated commodity?
yeah. I mean, Largo is the kind of the only game in town. There's a few others, but I think Largo is really the biggest and the most investable. They're one of the lowest cost producers, but they're still struggling. So it's definitely getting to the pointy end. But that's what you want to see, in these kind of reversal moves. When the lowest cost producer is having issues, and threatening to reduce production, go offline, even almost go bankrupt. That's Yeah, I think that's what could threaten kind of a rebound in the commodity price. So yeah, that would be the first place I'd look.
Incredibly insightful there. Thank you, Edward, for sharing that. Another way to look at the mining industry might also be to look at geographical locations that might be opening up, geopolitically speaking, or a new frontier in the exploration game is opening up. Are there any geographic locations that are catching your eyes? For example, I hear a lot about the Nubian Shield, Arabian Shield, Guyana Shield. Any of those places that are of particular interest to you?
Yeah, I mean, we've been invested in the Guyana Shield for a long time, and have done quite well there. And G Mining's recently gotten involved as well. There's a few players in there in the Guyana Shield. The Arabian Nubian Shield is very prolific, in terms of mineral belt, higher risk. But there's a few players there, Ivanhoe Electric being one of them, and I think they were listed on Morgan Stanley's kind of list of companies on the rare or strategic metals side to watch for. And there's a few other players there too. So, but it's less advanced. There's fewer players, and it's riskier. But we're watching that area as well. Um, and yeah, I mean, the Guyana Shield's really where we've focused a lot of our attention, have done quite well. I think Mexico was, it was really out of favor for a while. It's kind of coming back. It's still pretty risky. You don't know really which direction the administration is going to lean into. We're definitely getting, a lot of kind of positive feedback from mining companies operating there, but who really knows? But I think that was an interesting opportunity when, everyone was kind of fearful of it. Having been able to talk to mining companies who are on the ground, actively talking to politicians and having a better understanding of it, gave us more comfort than perhaps people just reading headlines. And then, Argentina has been a big frontier that's opened up recently. The elections notwithstanding, obviously. Now it's, I guess we're watching it a little bit more closely with the recent developments, but that's been yeah, that has opened up a lot recently, and it's great to see because there's a lot of high quality projects there too.
Interesting that you mentioned that the Nubian Arabian Shield is higher risk than some other places in the world. Why would you say that is? Because if one looks at the opportunities available, if it's a place that hasn't really been properly explored, you would think there's also more value to be found, especially if it's a well-endowed part of the world.
Yeah, it just depends on which side of the Arabian-Nubian Shield you are. Um, Obviously, if you're working with Saudi, I think it's, lower jurisdictional risk. Um, if you're on the other side, then, I mean, there's still wars going on, civil wars, and it's just harder to operate. Um, so yeah, I mean, definitely it's better value, but value can be a trap as well. So just because something's trading at, insanely low multiples doesn't mean it'll necessarily go up. And in fact, sometimes the stocks that are trading at the highest multiples end up performing the best. They just have that consistent premium because they're operating in safer jurisdictions. They have better projects. They can deliver better value to shareholders, or at least they can keep delivering on, adding ounces through exploration. Earlier stage projects are always going to look cheaper, but that's the risk you take. Um, Hopefully you make a discovery, but discoveries are hard to come by. I mean, probably easier in the Arabian-Nubian Shield just because of it's been underexplored. Um, but it's still, exploration's not easy, and especially, for large kind of tier one, tier two deposits, those are few and far between.
Well understood, and also appreciated additional color on countries like Mexico and Argentina now recently reopening up for exploration, really, or at least relatively modest risk exploration. Are there any other places on Earth, shields that you might be looking at, where you might be seeing an interesting value proposition like the Nubian Arabian Shield, that's just very underexplored?
Any other places? I mean, I'm still invested in West Africa, but that's not a new play at all. I'd say that's kind of an evolving jurisdictional kind of risk. So, you have to be selective of the countries that you're willing to invest in. But I mean, there have been some great discoveries made there, and still a lot of M&A happening in West Africa. Um, and then, beyond that, uh, I think Dundee, operating in Serbia is quite interesting. I think that whole belt uh, has also been pretty underexplored. But again, it's difficult to operate there too. There are not that many operators, and um, it's not necessarily, yeah, it's just they're just difficult jurisdictions to operate in because of kind of environmental challenges. And if you don't really know the lay of the land, then it's going to be hard for you to get the permits and to get that exploration done. So, yeah, I think that's a really interesting part of the world, but there's not that many players that are that investable, in my opinion.
Edward Bonner, tremendously appreciate your insights and your time today. Perhaps you can lead the viewers to your newsletter for a second and tell them how they can find out more about you and what you do over there.
Yeah, they can reach out to me if you just include, my email. They can email me or they can call me. You can include my phone number. I'm an investment advisor at Sprott Wealth Management, and they can also just go through the contact page on Sprott's website and just include my name, and that's an easy way to reach out to me. But that's pretty much it. Yeah, I'm happy to talk to whoever. I think as much as it's helpful to investors to talk to me, it's also helpful for me to get their point of view, to hear their questions, and sometimes they're things that I haven't even thought about or haven't heard of. So it's really useful just to talk to a whole host of people, because you can't really, I mean, there's only so many things that one team can look at. So it's always useful to have conversations with clients and new investors.
Definitely. Edward, thank you so much for today. I really appreciate it.
Yeah, thanks a lot. I appreciate it.
This podcast is for general information purposes only and does not constitute investment advice, an offer, or solicitation to buy or sell any securities. The views expressed are those of the host and guest and do not necessarily reflect the views of the company or their affiliates. Guests on the show are not compensated for their appearance. Certain discussions may include forward-looking statements subject to known and unknown risks and uncertainties that could cause actual results to differ materially. Listeners should do their own research, consult a licensed financial advisor, and not base any investment decisions solely on the information discussed. For a full disclaimer, please visit our website, and for full disclosure and risk factors of any companies referenced, please see full available disclosure and risk factors on their CEDAR Plus at www.cedarplus.ca.